Hello everyone. Today's topic is money supply and its components. Let's first understand the definition of money supply. Remember, money supply is a time specific concept. So the definition is money supply refers to the total stock, means the total stock, that is, it includes the cash, coins, balances held in the bank accounts. So, money supply refers to the total stock of money available in an economy at a specific time. At a specific time, money available with public. This is what we have to remember. And RBI is the one which monitors and regulates the money supply to ensure economic stability and the growth. Now, we have to understand why money supply is important and why it should be regulated. So, the importance of money supply, it should be regulated because everything that is being done within an economy is an outcome of revolving and circulation of money as the economic activity. It influences consumer spending. The more the money will circulate, the more the consumer will spend. The businesses can invest more if the money will circulate with higher velocity, but it comes with a cost that if the velocity of the money is higher, then it brings inflation with it. We have to remember this concept. So RBI regulates the money supply so that the velocity of the money can be controlled. The second is the inflation control. Just now we talked about if the velocity of the money will increase, then the inflation will occur. Then the RBI uses the tool of money supply to control the inflation. And then the interest rates. The money supply also affects the interest rate. If the money is easily available to the public, the interest rates might differ than compared to there's a shortage of money. So we have to remember these two concepts. Now to the components of the money supply in India. Basically, there are basically M1, M2, M3, M4, and then there's M0. That is the high powered money or the base money, as we can call it. We first have to remember that in every country, every federal bank, like in India, the Reserve Bank of India mainly focuses on M0, M1, M2, and M3. RBI doesn't use M4 for its monetary policy. So let's dive into the concept of the M1. M1 is also known as the narrow money. Why it is known as the narrow money? Because it only calculates the money that is available as the most liquid, as in the most liquid form. Currency with the public, like the coins, the paper, money held by the public, the demand deposits with banks within the current accounts, and the other deposits with the RBI includes demand deposits of public financial institutions and foreign central banks. Now to the M2, we can call it broad money. It includes the M1 components, as we have discussed above, and it also includes saving deposits with post office savings banks, though these are the funds in post office saving account. We have to remember this. Now to the M3. M3 is the broad money. Again, it encompasses the M2 components plus the time deposits with banks which include fixed and recurring deposits with commercial banks. Our FDs, those are the fixed deposits, are included in this, as they are not easily convertible into the liquid money. Now to the M4, the broadest measure of money. It encompasses the M3 components as well as the total deposits with post office savings banks, but it excludes the national savings certificates. We have to especially focus on this particular statement, that it exclude national savings certificates. This is the important thing in this particular M4 thing, that we have to remember this. It first M3 plus total deposits with post office saving banks, but it exclude national saving certificate. Now we can summarize it with simply summarize it. M1 is the currency with public, demand deposits with bank and other deposits with the RBI. M2 is the M1 plus savings deposit with the post office saving banks. M3 is the M2 plus time deposits with bank, and that is the FDs. Then the M4, the broadest of all, M3 plus total deposit with post office saving banks. As we have already discussed, it exclude